Love him or loathe him, when Warren Buffett speaks, people are all ears. He is quite possibly the greatest investor of all time. Nicknamed the Oracle of Omaha, the CEO of Berkshire Hathaway has shown his ability to read Wall Street like a book. He has a net worth of nearly $82 billion according to Forbes, making him one of the richest people on the planet. Not surprisingly, investors relentlessly clamor to match his success by analyzing his portfolio, hoping to absorb even a tiny morsel of Buffett's investment genius. Berkshire made over $10 billion by buying up companies that were in dire straits during the financial crisis, banking gains of up to 40%. All too often, though, persistent Buffett-related misconceptions managed to spread among the masses, running almost entirely unchecked. Despite his investing bravery, there have been a few Warren Buffett mistakes over the years. Unlike some executives who try to pass the blame to an underling, however, Buffett owns his errors and assumes full responsibility when he fails to deliver to shareholders. With that said, today we are debunking Warren Buffett's portfolio. In 1993, Warren Buffett purchased Dexter Shoe Co. for $433 million in Berkshire Hathaway stock. However, in his 2007 letter to shareholders, Buffett explained the poor decision, admitting it cost investors $3.5 billion, which at the time was 1.6% of Berkshire Hathaway's net worth. This led him to state that Dexter was the worst deal he'd ever made. As a financial disaster, this one deserves a spot in the Guinness Book of World Records, he wrote. Though we're most certainly not buying and selling million-dollar companies, we can all learn from Buffett's mistake by ensuring our resources are properly allocated. The worst of Warren Buffett's stock picks underscores a key lesson. A company is at its best if it has a viable competitive advantage. If there's no solid reason for customers to continue patronizing a brand, it's likely destined for failure. In 2011, Warren Buffett and Berkshire Hathaway were under fire after it was revealed that David Sokol, then chairman of several of the firm's subsidiaries, pitched Lubrizol Corp to Buffett as a potential takeover. The problem was that Sokol owned stock in the chemicals company. Berkshire bought Lubrizol for roughly $9 billion, and Sokol earned a $3 million profit. Since he hadn't disclosed his stock ownership to Buffett, this violated insider trading rules. Buffett didn't realize his mistake immediately, but at the 2011 Berkshire Hathaway annual meeting, he admitted that he should have probed deeper with Sokol. On September 26, 2019, a fire originating at a small next-door operation spread to a large French plant owned by Lubrizol, and the result was significant property damage and a major disruption in Lubrizol's business. Even so, both companies' property loss and business interruption loss will be mitigated by substantial insurance recoveries that Lubrizol will receive. Back in 2015, Warren Buffett called himself out in his annual letter to shareholders for dawdling in unloading his investment in UK supermarket giant Tesco plc. Berkshire Hathaway owned 415 million shares of the UK-based grocer at the end of 2012, and though the firm sold some stock, it remained heavily invested. In 2014, the grocer overstated its profits and shares tumbled. In his letter to shareholders, Buffett said concerns about Tesco management motivated his initial sale of stock, which resulted in a $43 million profit. Unfortunately, he didn't move quickly on the rest. An attentive investor, I'm embarrassed to report, would have sold Tesco shares earlier. I made a big mistake with this investment by dawdling, Buffett wrote. He admitted the move cost the company $444 million after tax loss. Warren Buffett told shareholders earlier this year that he had sold all of the company's airline stocks, admitting that he had made a mistake and that coronavirus had changed the business in a very major way. Buffett confirmed that he had sold all of his stakes in the 4 largest US airlines. It has gotten to the point that Warren Buffett's investment miscues are drawing the attention of President Donald Trump, who teased Buffett at the White House for dumping airline stocks before their recent surge. The world has changed for airlines, Buffett said, noting that the industry industry has been really hurt by a forced shutdown due to the coronavirus. With the pandemic effectively halting global air travel, US airlines are now receiving portions of $25 billion in federal grants and loans. Collectively, Berkshire sold 175 million shares in the 4 air carriers, and the stakes were worth a total of around $4 billion at the time. In the case of DAL, he sold off the 71.9 million shares in Berkshire's portfolio in quarter 2. As for the others, UAL share sales came to 22.2 million, LUV shares were 53.6 million, and the AAL stake comprised 41.9 million shares. It turned out I was wrong, the Oracle of Omaha said, adding that he'd made an understandable mistake given the unforeseen downturn in the industry. Even though Buffett is a great investor, that doesn't mean people should all follow his lead, buying every stock he buys each quarter. He's working with a capital base so large most retail investors just wouldn't be able to fathom what to do with it. Plus, Buffett himself admitted one of our greatest strengths as small investors are having less money, which in turn gives us access to a much wider investment universe he no longer enjoys. According to Matt Copenheffer, the author of the Motley Fool's free special report, Warren Buffett's Greatest Wisdom, when Buffett buys a stock, there's a rush of everyone buying the exact same thing, but that misses the point. The Buffett lesson is to know certain areas really well and stick to your circle of competence, not just buy exactly what Buffett buys. So while you won't go broke copying Buffett's portfolio today, if you want to truly mimic his past successes, you're better off doing your own preparation and looking elsewhere. In 2008, Buffett bought a large stake in the stock of ConocoPhillips as a play on future energy prices. Many might agree that an increase in oil prices is likely over the long term, and that ConocoPhillips will likely benefit. However, this turned out to be a bad investment because Buffett bought in at too high of a price, resulting in a multi-billion-dollar loss to Berkshire Hathaway. In his 2008 shareholders letter, Buffett wrote, "Without urging from Charlie or anyone else, I bought a large amount of ConocoPhillips stock when oil and gas prices were near their peak. I in no way anticipated the dramatic fall in energy prices that occurred in the last half of the year. Buffett spent just over $7 billion on 85 million shares of ConocoPhillips, but its market value at the time of the letter was only about $4.4 billion. Since crude oil prices were well over $100 a barrel at the time, oil company stocks were way up." In a 2010 interview, Warren Buffett said the dumbest stock he ever bought was actually Berkshire Hathaway. Buffett explained that he first invested in Berkshire Hathaway in 1962 when it was a failing textile company. He decided to load up on the stock as he thought he would make a profit when more mills closed. Later, the firm tried to chisel Buffett out of more money. A spiteful Buffett bought control of the company, fired the manager, and tried to keep the textile business running for another 20 years. Buffett estimated that this vindictive move cost him $200 billion. Now, during the second quarter, the firm bought back $5.1 billion in Berkshire shares, which follows $1.74 billion in repurchases during the first quarter of 2020 and another $2.2 billion in quarter 4 of 2019. In the most recent round of buybacks, Buffett picked up more than $4.6 billion of Berkshire Hathaway Class B stock and about $486.6 million in Class A shares. However, shares in BRK.B lost 2.6% for the second quarter, a time when the broader market rallied by nearly 20%, and the conglomerate stock is down almost 7% for the year to date. Warren Buffett admitted to shareholders at the 2017 Berkshire Hathaway annual shareholders meeting that he made a mistake by not buying Google shares years ago when the company was getting $10 or $11 per advertising click from Berkshire Hathaway consumer insurance company subsidiary Geico. Buffett has shied away from tech stocks in the past because he didn't understand their models. Still, he said he should have figured them out because he was effectively a client of the Google ad business. Shares in Google's parent company Alphabet have surged nearly fivefold in the past 7 years. If Buffett had invested $500 million at the start of 2013, it would be worth almost $2.5 billion today. Buffett missed another chance to take a big stake in Google when its founders Larry Page and Sergey Brin and then CEO Eric Schmidt visited the investor in Omaha, Nebraska in late 2000s. The trio ended up modeling Alphabet on Berkshire.